What is up, everybody? Dan again, stocktrades.ca. Welcome back to the Stock Trades YouTube channel. It seems like forever since we've posted a video. I think it was earlier in 2022. We came back to the channel for a short stint, left it again, but now we are definitely coming back in full force at the end of 2022 and 2023. Now, I am currently in the process of moving, finishing a house build. So right now I don't really have a filming studio. So you're probably going to see a lot of sporadic situations on video. But for the most part, I'm going to be doing screen shares until early 2023. It's just way easier that way. And plus, you're probably going to get a lot more value out of those instead of, staring at my mug all day. So I'll be turning it around to the screen. I'm going to be going through our Y charts platform, and I'm pretty much going to be walking through step by step, how I analyze particular stocks, what I see in particular stocks. And in this video, I definitely want to highlight options for your tax-free savings account, especially if you are somebody who is income focused. So with that being said, let's turn it around to the screen, and I'm going to start with our very first stock, which is one of the most popular oil and gas stocks in the country. So before I get started here, I just want to let you know that, in order to get some momentum back on this channel, I really need you to smash that subscribe button, head down below, like the video, and most importantly, drop a comment. I will make sure to personally answer every single comment that gets dropped below. But the first stock I wanted to go over was Canadian Natural Resources. And this is, in my opinion, the premier oil and gas company in Canada. Now, a lot of people, they don't necessarily understand the oil and gas market enough to go chasing small to mid-cap producers. There are a lot of very intelligent people that understand this industry inside and out. I am not one of them. That's exactly why I own XEG, which is an oil and gas producer ETF. This essentially gets me large-scale exposure to Canadian Natural, and, I think it's 10 or 11 other major producers, might be more now, oil and gas and natural gas producers. But I believe if you're looking for an option to just buy it and hold it, this is arguably the only one, in my opinion, that you should be looking at in the country. This is Canada's best oil and gas producer, major oil and gas producer, and you'll see how drastic it is even more when we go to charting and look at the overall returns and performance versus other major producers. Now, this is a Y charts dashboard. I'm going to do most of my videos actually walking you through this Y charts dashboard because it is such a quality place for information. I believe this is hands down the best investment platform for investors looking to save time doing their research, and just the sheer amount of metrics, the sheer amount of data available to you to make stronger decisions. The only downfall with this is it is largely unavailable to retail investors. It's, I think, price point, it's over $200 a month for a subscription. So you really do have to have a large portfolio or put a ton of time into this platform to make it worth it time-wise to justify that subscription cost. But I hope with these videos being screen share and I'm showing you this dashboard, I'll give you some insights into companies that you may have not seen before, just skimming regular resources like Yahoo Finance or Reuters or whatever else it may be. So Canadian Natural, as mentioned, one of the largest natural gas producers in Western Canada, heavy bitumen, synthetic oil, natural gas, NGLs, 1.16 million barrels of oil per day equivalent in 2020, and it's got nearly 12 billion in reserves at that time as well. We look at a market cap of nearly $90 million pre-pandemic. Nowhere close to this amount. Canadian Natural has really excelled, primarily due to the fact that this company has extremely low break-even price. It can profit, when we see $70 to $80 WTI, Canadian Natural is printing money, even at those price levels. And you'll see when we get to performance how much this has helped the company outperform its peers. Dividend yield of 4.17%. It pays 85 cents a quarter. This is going to go up. The company is so flush with cash. Even now that the oil euphoria has settled a bit, this company is generating a ton of free cash flow, and it is no doubt going to keep jacking the dividend. Remember, this was a company that even in the pandemic, as we see right here, as prices absolutely collapsed, this company raised the dividend while companies like Suncor were slashing the dividend. Obviously, when we look to a beta, this company does have a beta of 2, suggesting it's way more volatile than the market, and that makes complete sense. Because this company is an oil and gas producer, it is going to rise and fall with oil, which has been insanely volatile over the last year, even year and a half. And when we look to revenue growth, 5-year revenue growth of 22.31%, a lot of this growth is going to be in a post-pandemic environment. These companies weren't growing that fast pre-pandemic just because the price of oil was struggling so much. But if we look at key stats here, we can see free cash flow of $14 billion. This will be trailing 12-month free cash flow. So when we consider that Canadian Natural is trading at only an $88 billion market cap, the fact it is generating trailing free cash flow of $14 billion. This company is very cheap on that basis. Now, just because it's an oil and gas producer, it's never going to command that high of a premium. If you had a technology company generating this amount of cash flow, it would never be trading at sub 10 times that cash flow. But it is an oil and gas producer. We can expect these discounted valuations for good. They're never going to realize high scale valuations on that front. If we look at return on equity, 31%, return on invested capital, 23%. We want to look for companies. Primarily, what I look for in companies is double-digit returns on equity and double-digit returns on invested capital. And we want to see those returns on invested capital trending upwards or at least staying flat. And with a company like Canadian Natural, as you can see, it is cyclical again. So these are going to be heavily dependent on the overall price of oil. When we go down to the dividend, as mentioned, it's got a yield of around 4.17%. It's paying out around 38% of earnings, and it's paying out around 33% of free cash flow. This dividend is going to continue to grow, as I mentioned. With these coverage ratios, even if the price of oil dips a bit, it's going to be able to cover that dividend quite well. If we go down to liquidity and debt, debt to equity ratio of 0.33, this company is very strong debt-wise. We can see interest coverage ratios of 25 times. This company is, as mentioned, flush with cash. Go up to estimates, we can see that the company is expected to post a massive gain in 2022 compared to 2021. We're looking at, reported earnings per share of $6.25, and now they're expected to close the year out with nearly $12 in earnings per share. However, we can see that oil is likely to settle as we head into 2023 and 2024. Earnings are expected to dip along with revenue. This is not a gigantic deal. I believe Canadian Natural is cheap enough right now that it already has most of this decline priced in. If we look at a share price of $80, this company is trading at only 10 times its 2023 earnings, which I believe, valuation-wise, this is a steep discount to what Canadian Natural typically trades at. And if we do look to its valuation, we can see that this company is trading at only 6.6 times its trailing cash flow. And its 5-year average is 9.3. Forward price to earnings of 7.7. This is different than 2023 earnings, as this is I believe a trailing 12, a forward 12-month basis, not necessarily a full next year. Whereas those estimates I showed you were the entire fiscal 2023. But as we can see, this company is very, very cheap. And when I look to it from a fundamental standpoint, and I want to show you Canadian Natural's performance versus its peers, so I'm just going to add Imperial Oil into here and Suncor into here, and we're going to look at total return price. Let's add in annual revenue. Let's look at earnings per share. And let's look at free cash flow. So if we look at Canadian Natural compared to its peers, on a 5-year basis, we can see that this company simply crushes it. It is actually, Imperial Oil has kept pace with this company in terms of overall share price growth, but when we look to revenue growth, Imperial Oil is the clear-cut winner. When we look to earnings per share, Imperial Oil has jumped quite a bit, but honestly, I think that's an outlier, because when we look to free cash flow, really what truly matters, Canadian Natural has dominated Suncor and Imperial Oil over the last 5-year period. Overall, this company is just, in my opinion, the most efficient major producer. And if I was to buy one single oil producer for a buy and hold, it would be Canadian Natural. So the next company I want to look at, and is one that I've actually held pretty much the entirety of my investing career, and that is Fortis. Now, Fortis has taken quite a dip in price. I mean, if we look at the last 6 months, this company has been on a large-scale drawdown, and many people might be confused at how this company, which typically has a beta of 0.05, this thing essentially trades like a bond. But recently, there has been a large-scale sell-off in a company like this, primarily due to rising interest rates. And as such, the beta has actually gone up on Fortis. It's actually at 0.23 now. It's still not very volatile at all. But interest rates have really put some pressure on this stock. And the main reason for this is when we have things like GICs yielding, I don't even know, a recent GIC, I think you can get 5.1% from Equitable Bank. When we look at regulated utilities like this, people really don't see value in holding Fortis and earning 4.3% rather than just buying a one-year GIC and earning 5.1%. But one of the main promises I see right now is the fact that because Fortis has, suffered this large drawdown in price. And if we go to the fundamental chart and we go to 6-month returns, we're looking at returns of minus 16% over the last 6 months. Even on the year, it's down 13.5%. I think just narrowing in on that dividend yield is probably not the best thing for investors with a long-term horizon. If you are short-term, you're in retirement, you're looking for something, that is going to give you a bit more yield, it would make sense to, probably buy that one-year GIC over, the risk, although it's very minuscule with a company like Fortis, the risk of holding that equity. So that makes sense. But if you're a long-term investor, who's buying this company and owning it for, the next 15, 20 years, this dip in price, it's not just the yield you're going to lock up. It's likely that long-term price appreciation too, which in my opinion, with the prices that Fortis is trading at right now, is likely going to be a lot more than 5% annualized. This company already provides you 4.3% with a dividend. It doesn't necessarily need to provide you all that much in price appreciation. And I really do think that we are on the end scale of interest rate increases. We're going to see a few more in December, but overall, it's not going to get hit with the massive rate increases that we saw, over this period of time. So likely prices have, I don't want to say bottomed, but they've come somewhat close to a bottom. We can see in terms of valuation, this company is trading at a 6.5% discount to historical valuations. It definitely did run up in price a bit during the pandemic. Obviously, these companies are heavily indebted, so when money is free like it was, it's definitely going to have an impact. But this is a company that generates 99% of its earnings through regulated utilities. So as a result, many people who are beginner investors to utilities will come down to the liquidity section, or not the liquidity section, obviously. This is just on Y charts. But they'll see things like they have an interest coverage ratio of 2.63. They have a quick ratio of 0.35, which suggests that this company is, not going to be able to satisfy their short-term debts, and, a current ratio of 0.26. These all signal a very weak balance sheet when you're quickly scoping companies out. But when we look to utilities, especially a company like Fortis that has such a high amount of regulated utilities, its cash flow is very consistent. So it can maintain a pretty tight balance sheet like this, because realistically, it knows the amount of money it's going to have coming in. This isn't going to be a very volatile company. Even, in a recession, utilities need to be paid. Now, the rate increases and inflation are going to impact Fortis, but this company is going to be able to negotiate higher rates. It is eventually going to even out for Fortis, and they're going to be able to kind of regulate that inflation and not take advantage of it, but kind of mitigate the impacts. So dividend, again, this company pays 4.3%. We see negative free cash flow. Obviously, this is a trailing 12-month basis. Fortis has had negative free cash flow payout ratios, expansion, how cheap cash was, it was in these companies' best interests to expand during those periods of time. They're likely, very likely, going to scale down capex, and as a result, free cash flow numbers will come up. Payout ratio, when we look to earnings, is 52.85. This company targets a payout ratio in the 60 to 70% range. So right now, on a trailing 12-month basis, the dividend is well below. And this company is 1 year away from becoming a Dividend King. So I have absolutely no worries about the dividend. When we go to estimates, we can see the company, this is not a fast-growing company at all. This is a reliable utility, one that's going to grow in the mid to high single-digit range. High single-digit range would be a very far stretch. It's probably going to give you mid-single-digit growth, and we can see that in earnings. I mean, $2.59 a share last year. They're expected to close with $2.76 this year. And as we head into 2023 and 2024, again, you're going to see that low single-digit growth. This company is more for reliability. You're buying this as, a foundational core holding in your portfolio that's going to hold up, relatively speaking. I mean, this is a pretty unique circumstance in 2022, just with the rate increases that Fortis has faced some pretty big volatility, but overall, I think this is an excellent opportunity to add Fortis to your portfolio right now. You're getting a much better price than you were 6-8 months ago. If your time horizon is longer, you're, not only are you grabbing that dividend yield, but you're likely grabbing a discounted share price and thus higher capital appreciation moving forward. Again, it's important to understand that as stocks get cheaper, that only means that strong companies like Fortis, buying them now just means larger future returns. So overall, everybody, I really hope you liked the video. We really need your support getting back onto the channel. We want to get more views to the videos, and the only way we're going to do that is if you smash that subscribe button and like the video, but most importantly, drop a comment down below. I answer every single comment that comes in our videos, and once we get the momentum going, we will definitely be back in full force delivering you some of the best content in the country. Again, we'll see you next time.